Today is Monday, March 30th, 2026, and something subtle but deeply significant has been unfolding beneath the surface of global financial markets. It hasn't dominated headlines, it hasn't trended across social media, and most casual investors have likely missed it entirely. But for those paying close attention, the signals are not just visible, they are unusually clear. Last month, Switzerland's largest bank made an announcement that should have sent shockwaves through the financial world. It revealed that withdrawals from one of its real estate funds would be halted for up to 3 years. Not days, not weeks, 3 full years. The official explanation was liquidity, a technical term carefully chosen. But behind that word lies a much more uncomfortable truth. When investors want their money and institutions cannot provide it, something inside the system is strained. What makes this moment even more important is not just that this happened, but that it didn't happen in isolation. Around the same time, multiple major financial institutions began restricting withdrawals from other types of funds, particularly in private credit. These are not fringe entities or speculative operations. These are pillars of the financial system, organizations that manage vast amounts of global capital. When several of them begin limiting access to funds within a short period, history suggests that something deeper is shifting. And while these events were quietly acknowledged and quickly moved past by mainstream coverage, the markets themselves did not ignore them. They responded in a way that has historically preceded major moves, particularly in precious metals. As of today, silver is trading just above $70 per ounce, with intraday movements pushing it even higher. Gold, meanwhile, is sitting in the mid-$4,500 range. On the surface, these are just numbers. But within those numbers are thresholds that matter more than the daily fluctuations most people focus on. For gold, the key level is $4,600. For silver, it is $71. These are not arbitrary figures. They represent confirmation zones, levels that, once held consistently, signal a structural shift rather than a temporary move. It is one thing for a price to briefly spike above a level. It is another for it to remain there, supported by sustained demand and conviction. Right now, both metals are approaching those levels. They have tested them, flirted with them, but not yet fully confirmed them. And that distinction is critical, because historically, once confirmation occurs, the behavior of these markets changes in a way that is both measurable and, to those who understand the pattern, predictable. Earlier this year, there was a single trading day that quietly marked a turning point. On that day, gold rose, silver rose, oil rose, and at the same time, equities fell. That combination matters. For months leading up to that moment, precious metals had been moving in sync with stocks. And when equities dropped, metals dropped too. Not because metals were weak, but because they were liquid. Assets investors could sell quickly to cover losses elsewhere. But on that day, that correlation broke. Metals stopped following equities downward and began moving independently. In market terms, this is called decoupling. And it is not just a shift in sentiment, it is a shift in behavior by large pools of capital. When major institutional money begins to move differently, it is rarely random. It reflects changing priorities, often driven by risk, liquidity concerns, or expectations about the future. The backdrop to this shift makes it even more meaningful. Many of the world's largest companies had already been declining significantly. These are not speculative names or minor players. These are companies that define entire sectors and influence global indices. When they begin to lose momentum while metals strengthen, it suggests a rotation, capital moving from one class of assets into another. Historically, this kind of rotation does not happen without cause. And more importantly, it does not happen without consequences. The pattern that is emerging now has appeared before, though not often. Over the past 50 years, there have been only a couple of periods that closely resemble the current setup. In both cases, the early signals looked remarkably similar. Stress within financial institutions, rising energy prices, shifting correlations between asset classes, and declining real interest rates. That last factor, real interest rates, is perhaps the most misunderstood and yet the most important. Most investors focus on nominal rates, the rates set by central banks or offered by financial institutions. But what actually matters for asset allocation is the real rate, which accounts for inflation. If inflation rises faster than nominal rates, then real rates fall, even if headlines suggest tightening. And when real rates fall, especially into negative territory, the attractiveness of holding cash or fixed income assets declines. In those environments, assets that preserve purchasing power, like precious metals, tend to outperform. This is not theory, it is documented history. In the mid-1970s, for example, interest rates were extremely high by nominal standards. On paper, they should have discouraged investment in metals, but inflation was even higher. The result was negative real rates and a surge in gold and silver prices. A similar dynamic played out during the financial crisis of 2008. Again, the initial phase involved declines, confusion, and widespread pessimism, But once the underlying conditions stabilized and capital began to reposition, the recovery was not gradual, it was explosive. Gold more than doubled. Silver multiplied several times over. What makes the current environment particularly interesting is that the same underlying forces appear to be aligning again. Rising energy prices are pushing inflation higher. Central banks are responding cautiously, increasing rates, but not at a pace that fully offsets inflation. The result is a gradual erosion of real rates. At the same time, liquidity concerns within major financial institutions are becoming more visible. When funds begin restricting withdrawals, it signals that liquidity is not as abundant as it appears. And when liquidity tightens, investors start looking for assets that are outside the system, assets that cannot be frozen, restructured, or restricted. That is where metals come into focus. Another key development is the growing share of global capital represented by gold and silver. When measured against the largest asset classes in the world, their combined weight has been increasing. Even small percentage changes in this context represent massive flows of capital. This is not driven by retail investors or short-term speculation. It is driven by institutions, entities that manage long-term obligations and make decisions based on risk-adjusted returns and systemic conditions. And institutions do not move quickly without reason. Looking forward, there are two broad paths the macro environment could take. In one scenario, geopolitical tensions ease, inflation stabilizes, and markets gradually recover. In the other, inflation accelerates, financial stress spreads, and central banks are forced into more aggressive responses. What is striking is that both scenarios, despite their differences, point in the same direction for metals. In a stable recovery, capital rotates into assets with momentum and historical strength. In a deteriorating environment, capital seeks safety and protection. Either way, the demand for metals increases. This is what creates asymmetry, a situation where the potential upside significantly outweighs the downside risk. These setups are rare, and when they appear, they tend to define entire cycles. Historical data provides a framework for understanding what might come next. In past cycles with similar conditions, metals did not just recover, they surged far beyond previous highs. The percentages involved were not incremental, they were transformative. Applying those historical patterns to current price levels produces targets that may seem extreme at first glance, but they are not arbitrary. They are based on what has already happened under comparable conditions. And that is where the psychological challenge emerges. Many investors are still waiting for prices to return to levels that no longer reflect current realities. They are anchored to past price points, hoping for a perfect entry that may never come. Meanwhile, the market moves forward without them. The cost of waiting is not just missed opportunity, it is the widening gap between where you intended to act and where the market actually goes. The alternative approach, supported by decades of market behavior, is gradual positioning, building exposure over time across different price levels rather than trying to time a single entry point. It is not a strategy that generates excitement, but it is one that aligns with how successful investors have navigated previous cycles. Timing also matters. Based on current trajectories, the window for confirmation in gold is expected within the next few months. Silver, which historically follows with greater intensity but a slight delay, may enter its most aggressive phase later in the year. This staggered behavior is not a weakness. It is part of the structure that has allowed silver to outperform in past cycles. Mining equities, on the other hand, operate under different dynamics. Their performance is influenced not just by metal prices, but by operational costs, particularly energy. When energy prices rise, margins can be compressed even as metal prices increase. This creates a lag that often resolves only after earnings. Data provides clarity. Understanding these nuances is essential, because without that understanding, it is easy to misinterpret short-term movements and miss the larger trend. As of today, the pieces are in place. Prices are near critical thresholds. Institutional behavior is shifting. Real rates are declining. Historical parallels are aligning. None of this guarantees a specific outcome. Markets are complex, and no model is perfect. But when multiple independent indicators point in the same direction, it becomes increasingly difficult to ignore. What happens next will not unfold all at once. It will develop over weeks and months, with periods of volatility and uncertainty along the way. But the foundation has been laid. For those who have been watching, analyzing, and waiting for clarity, that clarity is beginning to emerge. And for those who understand what the data is suggesting, the question is no longer whether something is happening. The question is whether they are prepared for what comes next.